Thank you for joining Market News with Rodney Lake. This is a regular program for the GW Investment Institute, where we talk about timely market topics. I'm Rodney Lake, the director of the GW Investment Institute. Let's get started. Welcome back to Market News with Rodney Lake. I am your host, Rodney Lake. Today is episode 13. We are in the Duquesne Innovation Studio. Thanks again to the Duquesne family, coming to you from the GW School of Business. Last week, we had our first guest on. It was Dean Perry. Thank you, Dean Perry. Again, great episode. Thanks for sharing your wisdom, and thanks for being in the studio with us. Today, what are we going to talk about? Back to the companies, another position in the GW Investment Institute portfolio, Visa. But before we start, a couple of things. One is a shout out to Sonia, who's been a loyal listener and watcher. Thank you, Sonia. Please keep the love coming. Very much appreciated. And a call to action. If you're watching the show, if you're listening, great. Please put some comments, review. We'd love to hear your feedback. That's the call to action. Thanks, everybody. Now, let's jump into it. Again, episode 13 on Visa. We're going to use the framework again to talk about Visa, business management, price valuation, and balance sheet, BMPB. That is the GW Investment Institute framework. We borrowed part of that from Mr. Warren Buffett, who's been mildly successful in this investment game. We added the balance sheet to that for our students. So let's start breaking it down. So Visa. Everybody probably has heard of Visa, and you probably have a Visa card possibly in your wallet or in your phone if you don't really have a physical wallet anymore. But what is Visa? It is a payment system. How do they, work in this way? Well, people might think that, they actually are taking on debt. They are not. They don't take financial risk. They're really this intermediary that sits in between the people who offer goods and services, the merchant in this case, the cardholder, possibly you or an individual, the issuing bank, let's say JP Morgan Chase, and the acquiring. So they sit in the mix of these. It's called the four-party system there. They make their money by charging fees on both sides of that transaction. And it's a very lucrative business. But again, they don't take credit risk as compared to, let's say American Express, who does. Visa and MasterCard don't. Visa, which is the focus today, has been an enormous success for our portfolio. Thanks to the person who put that in long ago. And it's really been, more than, let's say, a 17-bagger. That doesn't always happen. We certainly have things that didn't work, by the way. But this has been a great success for the Phillips Student Investment Fund in particular, but for the GW Investment Institute overall. Visa, back to the business. So let's start talking about, what's the quality of the business? We've talked a little bit about, how do they make money? They control the pipes in the network, really for the payment. They don't take the credit risks. So let's talk about what's their profit margin. So when you look at the profit margin, you're talking about 64% margins. That's the pre-tax margins. Is that a good business? That's a great business if you can have that. And so you're really talking about fabulous margins on the business. You're talking about you're not taking the credit risk on the business. So let's jump into a couple of other metrics here on the business. So what kind of revenue? You're talking $34 billion in revenue. That's a very significant business on June 30, ended 2024. So you're talking substantial numbers. You're talking a global enterprise. You're talking about a high profit margin business. So you think you're going to have to pay up, and we're going to get to the valuation. But Visa is a fantastic business. They're trying to grow this business. And really what they talk about is their top competition on the payment side is really when people move from cash to moving to the digital payment system. And it seems like that's the way that the world is moving. And they're going to continue to have competition. Again, MasterCard being maybe the top example that you would think of, but also from people like an American Express, a Discover, and Capital One combination. So we'll have to see how that all works out. But Visa is definitely in a dominant position and really has been extracting the economics for this system. You have Apple Pay coming in, you have Google Wallet. So other people are getting into the mix. And certainly you have PayPal, which has been a big rival, let's say, on the digital side since its infancy, but it's really sometimes using the backbone of Visa. So, and one small connection, so Rick Duquesne Hall here that we're in at the School of Business, ran a company called First Data, which was also into the pipeline business of the payment system for transactions. And he was twice CEO of that company. Just a fun fact for everybody out there. So let's get back to the business here. So what's the market cap of Visa? $575 billion approximately. That's a fairly large company, by the way. So it's a very large company. It really has a good profit margin. It really on, let's say, the edge of where things are going as far as transactions and payments and the speed. And we also have competition from new things, like when we talk about speed, is Bitcoin as an example in this distributed ledger business. So that is a lot slower right now as an example versus Visa. So really, that's not a competitor in the sense of getting transactions settled very quickly. Possibly the blockchain speeds up and becomes more relevant, but you're really talking about something that's more of a smart contract versus getting payments to settle so quickly. And so maybe that's not a direct competitor right away. I wouldn't see it that way, but maybe it's evolving, something to think about, something to keep track of on the business side. So let's get back into the numbers a little bit. Again, on the margin side, let's talk about gross margins here. You're talking 70% gross margins. We mentioned NVIDIA a few episodes ago. That's the neighborhood that they're in. That's rarefied air for most companies. This is a fantastic profit margin, and it's something to be, sought after. As an investor, these are the kinds of businesses that you want to find. You're talking about net margins of over 50%. This is a fabulous, fantastic business. And what kind of cash are they generating? The free cash flow for this company is nearly $19 billion. And we're going to talk about the balance sheet. But just as a business, this is generating tons of free cash flow. It is a fantastic business. And so obviously the valuation probably reflects that. But when the company went IPO, we bought shortly after that and have done very well. But it's not about what has happened. It's about today and it's about tomorrow. So as an analyst, we got to really think about what's going on. But if you're looking at the metrics look good. And when you talk about the growth has kind of slowed down. You're talking 10%, looking forward growth the next few years. That's reasonably good growth. You're paying, you're going to pay up for that. And again, we'll get to what's the valuation for the company. But this is a fabulous business. You would much rather own a great business at a fair price than own a terrible business at a great price. So that's, Buffett talking again there. Okay, when we're looking at the business, you probably rate this 8, 9, or 10, depending on what you like. What you think the future of Visa is. But right now, this is a fabulous business. They're the vanguard on some of these things. There's competition on some of the areas that they work in. But when you think about digital transactions, you think about payments, Visa is certainly one of the first companies that probably comes to your mind. So they have that mind share, but they also have really a decent amount of market share, more than decent amount. They're a dominant player in that. And it's global business as well. And so as things continue to move around the world, they're going to take a piece of that. And when you're talking about taking a piece of the business, you're also talking about taking a percent, which means you're indexed to inflation effectively, because as prices go up, so do your fees on a proportionate measure. So also, not a bad inflation hedge. So now let's move on to the management. How has management been doing here? So the management's newer, let's say, but not necessarily new. Ryan McHenry has come in and really has taken over a fabulous enterprise. Where are they going to go with this company? It's really up to the new group here, or the newer group rather, to shepherd in what is all the things that they can do. Is it going to be, we're going to do major acquisitions? Is it going to be that we're going to develop new products in-house? Is it going to be some combination thereof? That is something that to be determined. And when we talk about the capital allocation acronym, let's really go over some of the things. First, let's talk about what are the dividends that they're paying out. So the yield is not a ton. When you're returning capital back to shareholders, you're talking about a little bit less than 1%, 0.75% dividend yield. So that's really not at the top end for anybody to think about. Not a dividend aristocrat, you would say, but a steady dividend payer. You're collecting something there, certainly cash coming out of the business to help that. But now we really need to think about and evaluate management today and moving tomorrow. Where are they going to grow this business? But because at 10%, that's good, but maybe not great. How are they going to continue their dominance? Number one, how are they going to protect that moat? And how are they going to grow? To protect the moat, they're going to need to develop probably new products to make sure that they cater to those customers. And you really have to dig under the hood, which we won't do a ton today. But as an analyst, you have to ask yourself those questions. Are they really protecting that moat by investing in R&D? Are they investing in new products and services and making sure that their current clients are happy? And are they trying to get those costs down? That's one of the top complaints from people that use these networks, is that the fees are too high for them. And so they really have to think about that. They got to invest in new products. They got to try to get that cost of delivery down as much as they can and remain profitable. and keep their clients happy. So on the management side, I think they're doing a relatively good job. I probably wouldn't give them the 8, 9, or 10, maybe the 7 right now, 7 or 8 right now. But I'd say good and maybe trending towards better. Now, let's move on to the valuation, and we might come back and touch on management just a little bit, but let's move on to the valuation. So when we're looking at the valuation, this is an enterprise that's been running for quite a while, so we can actually look at a PE here and get something out of this. So when we look at what's the PE, generally right now, you're talking about 28 times forward. That is, a little bit in line, a little bit higher than the S&P, not a lot. And when you talk about what's it been, the average has been 36 and the median's been 35 over the last 10 years. So you're looking at a valuation that is actually a little bit under where it has been over the last 10 years. I wouldn't call that significant. It's definitely a discount to where it has been, but I wouldn't call that a dramatic discount to where it's been. Then again, I would call probably the valuation a fair valuation. Not significantly discounted, not overpriced at the moment, certainly relative to itself and relative to the S&P 500, but certainly a little more expensive than the average company. But at 70% gross margins, you should probably pay up for a company like that. And you do. People understand that, and you're going to trade, again, 28 times, really close to 29, so call it 30 times forward. And you're talking about the median over the last 10 years is 35 and a half. Okay, so a little bit of a discount. Well, maybe people are concerned about where the company is going, that they're not going to have that growth that they've had in the past. 10%, not great. So they're putting that into the business, and maybe they're not thinking that, they're thinking rather that the management's not investing aggressively enough. And again, that's the work as an analyst that we have to do. And certainly our current students this fall semester are going to need to make sure that they understand where Visa is now, where they're going, and that they are figuring out ways, they being management, to grow that business. But you would call this, let's say, 30 times forward valuation, a fair valuation for a really fabulous and great business. Now, again, you may be concerned about where this business is going in the future. All right. Again, we're going to come back a little bit to probably each one of the segments, but let's move on now to the balance sheet. So when we talk about the balance sheet, what we're looking for as investors at the GW Investment Institute, and what we ask our students and our analysts to look for, are great companies run by really talented people that are fair valuations. Let's say we're not looking for steep discounts, sort of the old school Ben Graham style. We're looking for great companies, so they're going to probably have at least fair valuations, and we're going to have to pay up. And on the balance sheet side, we're looking for really a rock solid balance sheet, a fortress balance sheet, if you will. And Visa would be in that category. When you talk about cash on hand, you're talking about almost 20 billion in cash, 19.6 as of June 30, and you're talking about 20 in debt. So 20 billion in debt. So 21, if you round up. So really kind of a small net debt position here. Nothing to be overly concerned about on that side. But you're also generating almost 19 billion in free cash flow. And we mentioned that earlier. So you really don't have a huge concern. And when we talk about, okay, well then, because they have a modest amount of net debt, let's make sure that what's the interest coverage ratio. And we've talked about the interest coverage ratio before. It is EBIT, earnings before interest and taxes, over interest expense. And right now, you're talking about 32 times for Visa. So that's not something that we would be worried about, especially when they're generating almost as much cash in a year as they have in debt. So that's not something that we're worried about. The interest coverage ratio is very high at 32 times. So that's going to help us sleep at night. We're not going to worry about the balance sheet. They could maybe have a bit more net cash for us, or at least be on the net cash side rather than a modest net debt position as of June 30, 2024. But that's okay. This is not something we're concerned about. It's not a debt load that they have any problem servicing at 32 times. So when we talk about grading the balance sheet, we're definitely in that 8, 9, or 10. Again, it's the 1 to 10 scale for the Investment Institute framework, 10 being the best, 1 being something that's a total disaster. But in this case, we're really talking about 8, 9, or 10. So now let's go back over briefly each one of the components just to kind of pull it all together for this episode. So again, we're reviewing Visa, fabulous business. So the B, the M, the price, and the balance sheet, right? BMPB, the business. Let's go over the margins again, just so something that you would be excited about. gross margins of 70%, net margins of 50%, a global enterprise, not taking credit risk, really a technology business, right? They own this infrastructure and they're taking fees. And you have this four-party system that I'll just make mention of again, which is you have the issuing bank, you have the acquiring bank, you have the card holder, and you have the merchant, right? Those are the four parties in that system. Visa sits in the middle of that, and they're taking transaction fees there. So this is a fantastic business. And again, on the business side, in addition to having great margins, in addition to having a really, not taking credit risk, you are also indexed to inflation for the most part because you're taking a percent of those transactions. And if goods and services that are being paid for with those cards are going up, you're effectively indexed to inflation unless something changes about the way that they price their business. So you have this index to inflation feature built into the way that the business model is set up. And by the way, that is a great feature. Others really can't pass that along and get, in a tough situation. And inflation wasn't a problem for a long time, but recently in the US, it has become a problem. And so Visa has had protection from that inflation, unlike many other companies who have had to possibly deteriorate their profit margin to try to keep their market share. Well, they haven't had to do that. They're indexed to inflation because of their business model, so that's a good thing. On the management side, you have a newer management, not a new management. So we'll just talk a little bit again about the management. Ryan McInerney, you're talking, he's been there for about 1.6 years. But really, what's the capital allocation feature? Are they investing in this business? Are they growing this business? They're definitely putting time, energy, and attention to developing new products, to developing new services, to making sure that they defend that moat. And again, I encourage everyone, if you're going to look at Visa, you got to spend a lot more time on this component than we can have for just one episode. But this is really where the rubber meets the road on the capital allocation. You really need to talk about, okay, well, what is management doing to protect that moat? And what is it doing to grow the business? At 10%, not a bad growth rate that they have projected for the next few years. But, is that going to be enough to demand 30 times when we get to the valuation? Well, that's your job as an analyst to try to figure that out. So think about that. Do some additional work on that. Again, we're going to be having our students think about that and do some additional work on that. But management, fairly solid. Again, business, 8, 9, or 10. Management, I'd probably say 7 or 8 right now. McInerney's still relatively new compared to, somebody that's been in the seat for 10 years, let's say. But doing a good job, taking over the reins and continuing to push Visa forward. So I think that in general, you give a 7 or 8 right there for that. All right, now, on the valuation, we talked about the valuation. Again, this is not a cheap company. Let's say the forward is 30 times right now, approximately a little bit less than that. But that's not something 28, to 30. But let's round up 30 times to be conservative. Okay, that's not an inexpensive business when you talk about the S&P in the let's say 25, 23, depending on the day. So that's not something that's cheap, right? It's actually trading at a premium to the S&P 500. But when you have these 70% margins and 50% plus net margins, you should. So I think this is probably a fair price. And on this, you'd probably be thinking, that's a 7 or 8, something like that. Maybe a real solid 7, 8 maybe is a little too generous there. And now when we move on to the balance sheet and we talk about that, can we sleep at night? Well, I think we're sleeping at night pretty well with Visa, right? You talk about the balance sheet, 19 plus billion in cash, 20 billion in debt. So you're talking a modest, net debt situation, not something that you would be concerned about because they're generating 18 billion plus in free cash flow. And the interest coverage ratio is over 30 times. And so, again, on the balance sheet side, we're not concerned. So that's probably an 8 right there. So, depending on the scores that you pick, we're weighting those things at 25% each. Pretty simple and straightforward. You create a weighted average for that. And if you total up the scores that we've had so far, you're probably talking about somewhere in the neighborhood of an 8 for this, depending on how you scored everything. But that's a really fabulous score the way that we do it at the Investment Institute. So at the moment, Visa would continue to be a hold in our portfolio and something that we would have to watch. Now, where should we focus? So if I, have to say, like, where do I have, let's say, maybe not concerns, but questions that we want answered? Well, I would go straight into the management. And what are they doing? That would be the centerpiece of the work that we really need to do moving forward. We say the business right now, overall, the grade for Visa is 8. Well, what work can we do? We have to focus in on what management is doing. What are they doing to grow the business? How are they going to grow that business? Where are the investments going? What's that capital allocation acronym, right? We got to get comfortable with how are they allocating capital. As you know, there's only a few ways to allocate capital. So that's growing the business, and that's either through mergers and acquisitions or developing new things in-house. That is dividends, which we talked a little bit about, which are not super high, but that's not why people own Visa. That's buying back shares, or that's paying down debt. So, of the features that we talked about, what I will be asking students to do is make sure that we understand what the capital allocation is for growth for Visa, and making sure that people are in management are being responsible with the rest of the capital. The dividend policy we certainly don't want the debt to get out of control, but really the focus is going to be around what is management doing to help grow this business and defend their current business, because at 70% margins, of course, people are going to be coming after that. And you have people clipping at the heels like PayPal and others that are going to try to continue to erode that great business. But it's up to us to try to figure that out. And it will be up to the management team to try to make sure that Visa figures that out. So that's a wrap. Again, you're talking about an 8 overall for Visa for this episode. We're really appreciative of everybody out there that's been watching our episodes, or, either on YouTube or podcast. So thank you very much for that. We're going to be working on the next episode. If you have comments, if you have ideas, something that you would like to talk, you would like us to talk about, please let us know. And a reminder, this is not investment advice. This is for educational purposes. See you back on the next episode of Market News with Rodney Lake. Thank you. Disclaimer: the content shared in the GW Investment Institute podcast is for informational and educational purposes only and should not be considered investment advice. The opinions expressed in this podcast are those of the host and guest and do not necessarily reflect the views of the GW Investment Institute or the George Washington University. Listeners should not act upon the information provided without seeking professional advice from a qualified financial advisor. Investing involves risks, including the loss of principal. The GW Investment Institute, the George Washington University, and the podcast hosts do not assume any responsibility for any investment decisions made based on the content of this podcast. Always conduct your own research and consult with a financial advisor before making any investment decisions.